I am on slide number 2. The topics that we will discuss today is evolution of internal controls. Internal financial controls is a new subset of the term internal control. So we will look at the journey of internal controls. We will look at the global scenario of internal financial controls and specifically what are the India legal requirements of internal financial controls. We will look at the classical steps that are necessary for implementing an end-to-end internal financial control system in an entity. And these steps are in line with what the guidance note of the Institute of Chartered Accountants of India has pronounced. And we will also look at few examples. So I'll move on to slide number 4 now. You will see the gradual evolution of internal controls. Internal controls are nothing but those activities that prevent risk occurrence in an organization. In a very simplistic manner, if I were to put it, internal controls are nothing but a set of policies, procedures, operating guidelines, practices adopted by organizations, as well as authority structures. More popularly, we call them as maker's checker in our audit parlance. These form of activities prevent an event or a risk from occurring and causing damage to the organization. The subject of internal controls is a very old subject. It's not a new one. Today we are in the 5th generation of internal controls. It started off almost 100 years back with the advent of modern day management. In those days, internal controls were largely the physical and boundary controls, like the lock and key of a factory gate or the perimeter wall of a factory gate. Those were regarded in those days as the internal controls. Over a period of time, internal controls have moved several notches higher with experiences of business experiencing lot of control failures, lot of frauds, etc. The second generation of internal controls went on in the realm of financial statement monitoring, checking of financial ledgers, expenditure vouching, etc. Third and fourth set of internal controls was risk-based, risk-driven kind of internal controls, where organization went on to create enterprise risk management systems, risk-focused internal audit activities, and created plans to test the effectiveness of controls on the basis of risk assessment. And finally, we are in the 5th generation of internal controls today as we are speaking, where the internal controls have been automated by organizations in the form of control routines that happen in enterprise resource planning packages, on internet platforms, and so forth. A simplistic example here would be that if a particular person withdraws withdraws cash on the 1st of every month from, say, the Bandra West ATM in Bombay, and he does that for 24 months, but in the 25th month he goes to Andheri in Mumbai and withdraws cash from Andheri. So the system will pick up this exception and generate an alert, which is known as continuous control monitoring, or which is known as alert mechanism. This is also being integrated with robotic process automation activities nowadays. So the subject of internal controls has evolved over the last 100 years. Every 15 to 20 years, we see a tectonic shift on the subject of internal controls, which started off from physical controls to now the latest form of internal controls, which are continuous control monitoring. Internal financial controls are a subset of these internal controls. Internal controls largely are driven by 4 or 5 criteria. That is the controlling environment of the organization in the form of ethics, code of conduct, policies, procedures, the risk assessment processes that an organization design and implement. That is the second element. The third element is the controlling activities. Controlling activities in the form of process narratives, flowcharts, risk and control matrices, testing of transactions for effectiveness of authority, and so forth. And the last subset is on communication and on monitoring. So organizations have processes like internal audits, concurrent audits, process evaluations, control self-assessment. So these all also come into the category of internal controls. So that's the universe of internal controls that we should keep in mind while we look at the subject of internal financial controls. Now, why internal financial controls has gained so much of importance in the last 10 to 15 years globally as well as in India? Primarily on account of two reasons. One is better performance to be shown to investors, bankers, capital markets by CEOs and CFOs of company who have borrowed money or who have taken money from investors and are under acute pressure on a quarter-to-quarter basis to show better results, to show rosy results, as a result of which they take up and indulge into lot of accounting jugglery, where an asset becomes an expense or a liability becomes an income and vice versa. And I will throw some examples also. And the second key reason why internal financial controls have become so necessary is the advent of fraudulent financial reporting, where organizations have started indulging in window dressing of their financial statements and diverting funds for personal gains to the promoters. What are the vulnerable accounts? There are several vulnerable accounts in the balance sheet that can be tinkered, like cash, inventory, debtors, creditors, assets, salary, liabilities, expenditure, related party transactions. Now, let me give some practical example here. Say, for example, a software development company is there, and the software development company recognizes intangible assets in the balance sheet. It has got a policy to recognize intangible assets on the basis of the research and development work that it does. Now, the research and development work that it does will be supported by the salary payouts that happen annually. A percentage of the salary payouts will be recognized as research and development work and will be charged to the intangible asset. Software companies in India generally tinker or window dress on this particular aspect, where they don't have a standard intangible asset recognition policy in their balance sheets and they don't follow it consistently. So the percentage of salary year on year basis that goes into research and development is circumspect, and tax authorities have levied huge amount of notices and litigations on software development companies on account of this particular inconsistency. So this is one example where conveniently organizations can change their accounting policies to show a higher rate of intangible asset creation as a matter of adjusting their bottom line on an annual basis. Likewise, say for example, if an organization acquires an asset, a physical asset, and undervalues the asset, thereby suppressing the depreciation and inflating the profits. So such easy things are possible as far as accounting jugglery is concerned, or as we have seen in cases like Satyam and several other cases where there is inflation of revenue and then subsequent reversal of revenue. So there is fudging up of debtors, creditors and other balances. In India, this accounting jugglery is a reality. The Serious Frauds Investigation Office has reported that 15% of listed entities in India indulge in accounting jugglery. So as a result of that report, the government of India thought it fit that they should have a intense scrutiny of the financial statements in the form of internal financial controls, which is a separate layer of assurance to be provided to the board of directors and by the board of directors. Before we look at the subject of internal financial controls and the legal requirements, let's look at the common manipulation techniques. So when you all develop your risk registers for internal financial controls, you all can have these common manipulation techniques addressed in the risk and control matrices. First is alteration of accounting records and supporting documents from which financial statements are prepared. A very common example is employee reimbursement claims. If an employee has forgotten to put a claim in the month of February and he puts the claim in the month of March, he will conveniently change the date of his claim from February to March or from one year to another year by forging the underlying voucher or record. So this is a simple example of alteration of underlying records and supporting documents from which financial statements are prepared. Then there could be cases of omission of events and accounting transactions. Like say for example, if an organization has sold a asset in March, but decides to enter into the agreement in the month of April. So it has conveniently shifted the event date from March to April to the next financial year, not keeping in mind the bona fide of the transaction that happened on say 20th March or towards the end of the year, which is known as omission of events and accounting transactions. So for us, it is very important that when we see the accounting balances, we should try to evaluate whether this kind of manipulation has happened in the accounting balances from a fraud risk perspective. Deliberate misapplication of accounting principles is something that I dealt with in my earlier slide. Recording of fictitious journal entries and out-of-book adjustments. Most of the times we see in India that despite the most sophisticated ERPs in place like SAP, etc., as far as financial statements are concerned, these financial statements are prepared only on Excel spreadsheets, thereby leaving it vulnerable for the board of directors in terms of various adjustments that go onto the Excel spreadsheet. So one key internal financial control for us would be to verify the integrity of data in the Excel spreadsheets, the formulas in the Excel spreadsheet. Organizations engage in very complex and structured transactions to mislead shareholders, auditors, finance and accounts functions. Such as option contracts. Option contracts are those contracts where actually the underlying title does not get transferred, only the right to transfer the title is under obligation. So the actual transaction may happen at a future date. So organizations enter into complex option contracts to mislead auditors, to mislead board of directors in such a way that they have acquired the asset. Incorrect valuation of subsidiaries, intangible stock, property, related party transactions. So all these are some key examples in which accounting manipulation happens. Because of paucity of time, I will not be able to explain each and every line item on the slide. However, I'll pick up the key areas and explain them to you. Let's quickly take a look at the global scenario on the subject of internal financial controls. The advent of internal financial controls originated in USA in the name of Sarbanes-Oxley Act 2002. So it's a 2-decade-old concept. In India, it is a concept that is about 5 to 6 year old. However, in US, it is a 2-decade-old concept with the flurry of fraudulent financial reporting that happened in US. Around 350 cases of financial statement abuse were reported in US, which forced the US authority and the legislators to pass Sarbanes-Oxley Act 2002. And the mother standard that was pronounced after this act was passed is auditing standard number 5 of Public Company Accounting Oversight Board. So all the guidance notes of the institutes across the world, the accounting bodies, is based on this mother auditing standard number 5. I would request all of you all from an academic perspective to enhance your knowledge, go to the source of internal financial controls, that is auditing standard number 5 of PCAOB. It is available on internet. You can read it. It's a very lucid 40-50 pages standard, and that will give you enormous insight into how internal financial controls can be implemented. In US, the regime is very similar to India, where it is made mandatory for all the listed entities to file an internal financial control report by the board and by the auditors. In UK, the situation is limited and it is voluntary. It is restricted only to internal controls over financial reporting, We will come on the distinction between internal financial controls and internal controls over financial reporting on the next slides. So UK, the scenario is limited and it's voluntary, it's not mandatory. In Japan, it is made mandatory, much on the lines of US. And what all countries have done, including India, is with the advent of internal financial controls and also the fact that statutory audit has to be done together. So there is a growing consensus that it should be a combined audit, which is popularly known as an integrated audit. So when a statutory auditor does a statutory audit at the year end, he also looks at internal financial controls, their adequacy and the control effectiveness in a combined manner. So he does not go to the auditee 2 times in the year, but does an integrated audit. Let's look at our Companies Act 2013 provisions on the subject of internal financial controls. The key definition of internal financial controls is under 134.5. There is an explanation to the term internal financial controls. That means a set of policies and procedures adopted by the board for ensuring the orderly and efficient conduct of its business, including adherence to company's policies, safeguarding of its assets, prevention and detection of frauds and errors, accuracy and completeness of accounting records, and timely preparation of reliable financial information. So the definition of internal financial controls is pretty large and all-encompassing. It includes policies, procedures, orderly and efficient conduct of business, adherence to company's policies, safeguarding of assets, prevention and detection of frauds and errors, accuracy and completeness of accounting records, and timely preparation of reliable financial information. So what the definition shows is that unless organizations have got flowcharts, standard operating procedures in place, they will not be able to implement an effective internal financial control system. So just by preparing a risk register, organization cannot implement an effective internal financial control system. It has to have flowcharts, standard operating procedures, risk registers, fraud risk assessments, as well as has to timely close the books of accounts to ensure compliance with internal financial controls. The board of directors are charged with the responsibility under the Companies Act to make an annual disclosure on the subject of internal financial controls, that the company abides by the provisions of the Companies Act in terms of section 134.5. So most of the annual reports, you will see a disclosure by the board of directors under the director's responsibility statements that the organization has complied with the subject of internal financial controls. Now, what is the responsibility cast on the audit fraternity? That is on all of us. The responsibility cast by the Companies Act is to prepare a certificate by the auditor's office on the subject of adequacy and effectiveness of internal controls over financial reporting. So there is a difference between the definition that is applicable to the board of directors, which is very vast and all encompassing. As far as statutory auditors are concerned, their responsibilities is narrowed down to the fact that they have to look at only internal financial controls over financial reporting. That is the balance sheet and the P&L account of the company. To that extent, the auditor is charged with the responsibility of looking at the internal financial controls that are applicable to the financial statements of the company and issue a year-end certificate. There is a specific responsibility cast on various layers of governance, though people who are charged with corporate governance responsibilities like independent directors, audit committee chairs, non-executive directors, CEO and CFO. All of these people have to evaluate the integrity of the internal financial control system and have to satisfy them that the organization has effectively created an internal financial control system, has tested the system for adequacy, and has assessed the system, evaluated it on a 360-degree basis. The CEO and CFO's office have to give a certificate to this effect to the board of directors, which is also required under the listing criteria and the LODR requirements of 2015. One specific requirement here is that if there is any continuing control deficiency, the CEO and CFO's office have to flag that off to the board and to the shareholders. As far as applicability of the IFC is concerned, it is largely applicable to all the listed entities in India. It is applicable at the threshold, revenue threshold of 50 crores, borrowing of 25 crores. So that is the applicability in terms of IFC. As far as private limited companies are concerned, IFC is applicable to consolidated financial statements as well as to standalone financial statements. Adequacy in IFC has to be reported as on the balance sheet date. So most of the organizations in India typically tend to comply with IFC only towards the month of February and March. Almost the entire year they don't tend to do anything, and towards the end they try to comply with IFC. Historically, that is the practice in India. However, globally, organizations take it pretty seriously, and they have quarterly internal financial control testing programs which are given to a separate team or made part of the internal audit team. So the design of the internal financial controls in an ideal manner has to happen in the first quarter. The testing should start in the second and third quarter, and all the remediation should happen in the quarter 3 and quarter 4, and retesting can be done before the year end so that we can conclude that internal financial controls are adequate and operating effectively. Penalties for non-compliance include imprisonment up to 3 years and monetary consequences up to 25 lakhs in case of non-compliances. To summarize the subject of internal financial controls, organizations should develop orderly and efficient conduct of business in terms of code of conducts, in terms of employee work instructions, standard operating procedures. Organizations should do physical verification of assets, should have a recurring program for evaluating the existence and adequacy of assets. Prevention and detection of frauds and errors can be ensured through a fraud risk assessment exercise annually. Accuracy and completeness of accounting records to ensure that the financial statements are closed appropriately in line with budgets, in line with production, MIS, etc. And timely preparation of reliable financial information is ensured. So generally, you would see that listed entities try to comply by the timelines within 60 days, 45 days of the year end. And private limited organizations also have started timely closing their books of accounts with the advent of GST. There are two specific guidance notes issued by the Institute on the subject of internal financial controls. The first guidance note is applicable to large listed organizations that have multiple products, multi-product companies operating in several countries, in different geographical territories, regions, complex organization structure. This was issued in September 2015. This is a very detailed guidance note covering the classical implementation aspects along with illustrative risk and control matrices for each and every balance sheet line item. The second guidance note is issued by the Institute, which is applicable to smaller and less complex company, one promoter company with a single product and a single territory or region. This guidance note is more simpler. It has got less number of pages. It has got a frequently asked question as a background to the entire guidance note. FAQs are given. So smaller organizations can pick up those FAQs and start preparing their set of compliances with internal financial controls. Both the guidance note are equally enriching. I would suggest that if you all are wanting to do a detailed implementation, then refer to the first guidance note, which is more comprehensive, which talks of activities apart from internal activities. It also talks about outsourced activities, information producing entity. Outsourced activities are activities like payroll operations, data entry operations that are outsourced to third parties. Internal financial controls as a subject extends to outsourced operations as well. So if any of your clients are having outsourcing activity, they not only need to comply with internal financial controls for the main entity, but they also need to take into account all the outsourced operations, and they need to ensure that their vendors are also compliant with IFC for all the material processes that are outsourced. Like say, for example, payroll. Now, payroll can have a big impact on the financial statements if the figures are not accurately disclosed or are incorrectly disclosed. So if there are payroll computational errors, so the third party that processes payroll also should be compliant with internal financial controls. The guidance note also talks about one unique subject, which is information producing entity. Information producing entity is an entity that is outside the production software of the company, outside the tally, outside the ERP package of the company, in the form of an Excel spreadsheet. Like say, for example, debtors aging statement, which most organizations create in Excel spreadsheets. So the primary information is taken from the ERP, and then there is a slicing and dicing of information on the spreadsheet in terms of aging analysis, in terms of class of companies, sector-wise segregation. So the debtors receivable MIS statement is used by the CEO's office, CFO's office for the purpose of decision making, like write-offs, etc. So it is possible that the primary information is changed in character and in content and in frequency when it is ported onto Excel spreadsheet. So the institute guidance note says that the Excel spreadsheet should be recognized as an information producing entity and must be tested for effectiveness. So we must see what are the checks and balances exercised on the information producing entity by the client organization in terms of passwords, in terms of integrity of information, correctness of formula, distribution of those spreadsheets, etc. What are the implementation steps as far as internal financial controls are concerned? So there are 4 key implementation steps. First is to develop and implement a framework of internal financial controls. So audit committees develop a broad overview of IFC guidelines as to what will be in IFC guidelines, what will be in the IFC charter, and based on the charter, then the implementation exercise begins. In the implementation exercise, there is documentation of process flowcharts, risk and control matrices for material processes and significant accounting captions. And post that, then there is testing of internal controls and identification of control weaknesses. And the last stage is certification by the CEO's office, CFO's office on the testing results of IFC, as well as certification by the board and declaration of the responsibility statement. Now let's break that down further into 5 key areas. The first area is materiality assessment. Second area is assessment of entity level controls. Third is assessment of process controls and remediation of deficiencies. Fifth is control effectiveness reporting. And sixth is the board certification. The first step, which is materiality assessment, comprises of doing a materiality assessment of the trial balance of the client organization. The trial balance can be picked up for the year end, and it can be compared to the corresponding trial balance of the previous year end to see what are the changes, material differences between the 2 periods, and identify the delta or the change in the 2 periods to recognize what are the material items. Like say, for example, if the sales or the top line of the company was 100 crores in year 1 and in year 2 it was 120 crores, the change between the 2 will be 20 crores, which is 20% of the top line. So sales will be picked up as a material item. So any difference that is more than 5%, any delta which is more than 5% as compared to the previous period, may be picked up as a material item or as a significant accounting caption. So this is one quantitative measure. Like that, what organizations do is that they pick up materiality thresholds on the profit figures, on the capital employed asset figures, on the sales figures, like 1%, 5%, 10%, and combine 2 or 3 scenarios of materiality, and then prepare a master materiality chart, identifying the common accounting balance that have come across all the 3 3 or 4 scenarios. That is known as the quantitative assessment of the trial balance. What the practices generally also include are qualitative assessment of the trial balance in the financial statement. In qualitative assessment, the auditor and the auditor have to use their judgment to see which accounting balances are susceptible to frauds and errors. Like say cash in the balance sheet would be hardly 50,000 rupees, 5 lakh rupees or 10 lakh rupees, which may not be material compared to the size of the company. But cash is always susceptible to frauds and errors. So the auditor and auditee may want to pick up cash as a susceptible account on the basis of judgment. Or foreign exchange fluctuation. Foreign exchange fluctuation can be prone to valuation errors, can be prone to accounting disclosure errors. So that can be picked up as a susceptible account. So auditors overlay quantitative materiality assessment with qualitative measures to come up with a comprehensive set of thresholds and significant accounting captions. The second important step is designing entity level controls. Entity level controls are generally regarded as the control of controls. These are in the form of policy documents, code of conduct, and various high-level criteria that an organization desires to implement to make its culture compliant with ethical conduct of business. Entity level controls are those controls that are in the form of documented procedures. So we have to make a list under entity level controls in terms of applicable and relevant documentary procedures, policies applicable to the client, and then seek evidences against them. So for example, whether the client has got a whistleblower policy, how effectively the whistleblower policy has been implemented, whether the client has got a code of conduct policy and how effectively it has been implemented. All these things will fall into entity level control assessment, including internal audit function, risk management function, operations of the audit committee, board of directors, etc. So all these aspects will come under entity level controls. The third aspect is process level assessment. In process control assessment, we have to develop risk and control matrices, and we have to develop flow charts. So we'll come to some templates of that. Then we do testing of internal controls on the basis of the nature of control, whether it is automated, whether it is manual, on the basis of frequency of the control. Here we'll have to develop a sampling strategy on the basis of the prescribed guidelines of the Institute of Chartered Accountants of India. So where a control frequency is occurring for more than 25 times, the minimum on a daily basis, for example, say authorization of vouchers, which may happen on a day-to-day basis. So in this kind of a scenario, we should pick up a minimum of 25 samples to review whether the authorities are fixed appropriately on the vouchers or not. Where a control is happening once a month, say a bank reconciliation statement, we should pick up at least 2 to 5 samples annually to ensure that the control is adequately verified for effectiveness. Where the control frequency is once a year, we should do it on a 100% basis. Like say the year-end financial closure procedure, which the organization will exercise only once in the year in the month of March or April. So we should test that from a frequency perspective 100%. And finally, the test results should be summarized in the form of a dashboard, and we should present the dashboard in terms of the overall percentage effectiveness so as to lead to the board certification on the internal financial controls. Now, this slide summarizes the steps that we were discussing earlier. We do a materiality assessment to develop a scoping document, get approval on the scoping document of the chairman of the audit committee and the statutory auditor both, if we are in the implementation team. So the expectation is mapped properly from all the stakeholders. Then we move on to design phase. We design the process flowcharts through walkthrough of the processes by sequencing each and every process activity. So if you were to pick up hire to exit cycle, we will look at the stage from where the employee requisition is raised to screening, to interview, selection, induction, on-site job responsibilities, payroll process, and final exit of the employee. So this is called the design of the entire hire to exit cycle. So the implementer has to look at the entire hire to exit cycle and has to document the design in terms of a flow chart or a process narrative. The guidance note does not prescribe any one best method. It says you can either flowchart, you can use a process narrative, you can make a process checklist, or you can simply make a one-pager note. So it's not important what kind of a format you use. What is important is the content in the format and capturing the right kind of design of the process. And then doing a gap analysis by collecting evidence at each stage of the design to see whether the design is supported by adequate evidences at the ground level. So continuing the example of hire to exit, we need to see whether for each recruitment that is done, there exists an underlying employee or a manpower requisition form, which is duly authorized by the line of business. There has been a conduct of interview. There has to be a personal interview sheet as a evidence. Then there has to be an appointment letter, offer letter, appointment letter. There has to be evidence of induction training. There has to be evidence of a payroll processing, full and final exit and settlement of the employee. So in the design assessment, all these evidences will be collected to see the adequacy of the design to match whether what is flowcharted or what is narrated in the process is adequately backed up by evidences. So that is known as the design assessment, and operative effectiveness is collecting higher samples of evidence. So in design assessment, only one or up to maximum 5 evidences are collected, but in operative effectiveness scenario, which is the actual ground level testing, which is similar to our internal audit efforts, the sampling will be based on the institute's criteria, which I described earlier, with a minimum 25 samples. And then basis on that, you reach an overall assessment report or a dashboard to say to the board that how many controls were designed, how many were adequately operating, how many were tested for operative effectiveness, how many have passed and how many have failed. Now, typically for an organization to pass the muster for internal financial controls, 80 to 85% of controls have to pass. If 80 to 85% of controls don't pass, then you may not be able to reach a favorable conclusion on the pass rate of internal financial controls. This is a quick summary of the type of deficiencies. So control deficiencies that arise when you are doing testing of internal financial controls. So the deficiency will be a simple deficiency of a point of failure of a control, like continuing the example of hire to exit cycle. Say if the manpower requisition form is not available, so it's called a deficiency. But if an appointment letter and a manpower requisition form not available is called a significant deficiency failure. If the appointment letter, manpower requisition form, as well as the payroll computation sheet not available, which has a direct impact on the financial statement, all deficiencies clubbed together is known as material weakness. So material weakness is something which represents a material misstatement in the financial statement. And this needs to be reported to the board, to the audit committee, and to the shareholders of the company. So typically, organizations try to prevent auditors from reaching the stage of material weakness. They will try to rectify and remediate controls, demonstrate compensating controls, that if one control has failed, then there is another control that exists. And if the second one fails, there is another control. So ultimately, there is a chain of internal controls, and the highest control is the control of authorization, is the control of management supervision and review. So if the management is able to demonstrate to the auditor that effective supervision and management review has been exercised, still the auditor may conclude that it is not a material weakness. When we are doing the entity level control assessments, we need to keep in mind the following aspects: management philosophy, operating style, ethical values, functioning of audit committees, board, risk assessment process, centralized processing, compliances, human resource function, IT, compliance, CEO's office, philosophy. All these elements are important in designing entity level controls. So this is a brief template in terms of how we design entity level controls. So we have serial number. We try to put in reference to best practice, which is COSO, Committee on Sponsoring Organizations. COSO publishes very good libraries of internal controls. You can reference your checklist along with COSO attributes. You can put in the person or the function responsible, describe the controlling activities, whether control exists, yes or no, whether the control operates effectively, evidence collected, deficiencies noted, and the management corrective action plan. Process control assessment, you have these 4 buckets on slide number 23. So we do a process understanding, we sit with the process owners, we do a process walkthrough or a process walk back. We identify what are the sub processes within the main process. We document that in the form of a flow chart. I will show you one example of a flow chart as well. And we then prepare the risk and control metrics. So here we identify risks in terms of what can go wrong at each process step. And we will see an example of a risk and control metrics. And then we overlay that with our internal control testing strategy, as sampling strategy. We do the control testing in terms of design effectiveness, operating effectiveness, and we give a control deficiency chart to our clients, to our auditees, so that they can do the remediation of the deficiencies. And finally, we do the dashboard reporting. Now let's look at one example of a financial statement closure procedure. So FSCP is the heart of internal financial controls. So we need to prepare this kind of a flow chart. When we talk of a financial statement closure procedure cycle, it starts with the calendar of FSCP, which is planned sometime in December or January by the organization, by the CFO's office. The CFO's office will prepare a schedule for closure of books of accounts, and this schedule will be circulated to all the head of departments, to company secretary, internal auditors, auditor's office, etc. And post the circulation, then they will fix up a cutoff date to freeze the data from the ERP or from Tally or any other accounting package that they're using. After freezing the cutoff date, they will extract the trial balance, and from the trial balance, then they will start making certain provision entries, out of book entries that are important, that are necessary. And after passing of those out of book entries, the trial balance will be cast in the Schedule 3 format. And from casting of the Schedule 3 format, they will do a comparison with their budgets, previous year figures, corresponding figures, underlying volumes of the trial balance, underlying MISs, and they will try to identify any frauds or errors. And based on these comparisons, then they will try to rectify the financial statements that are cast in Schedule 3, and they will prepare draft notes and accounting policy disclosures. Post that, it will be circulated to the auditor's office. The auditor will review, he will conduct his audit, and he will come up with certain necessary adjustments. Like say, he will tell the auditees that, you know, the adjustment for the debtors is insufficient as per their scrutiny, and a higher amount needs to be provided for debtors, or the gratuity provision has not been done properly. So the auditee will take into account all those recommendations of the auditor and will recast and readjust and re-provide everything, and make a final financial statement for the review of the board of directors. And post that review, then there will be sign off, and then there will be filing of returns, there will be assessments, etc. So the financial statement closure procedure will start from calendarizing of the financial statements to the declaration of the results by the board of directors. So this is a broad overview. At each of these steps, the auditor has to do a risk assessment of what can go wrong in terms of information integrity, and test the control for design adequacy. So this is the design of the FSCP. The risk and control metrics can be prepared in this format, which is slide number 25. This is the template. Again, there is a serial number, COSO reference, a brief description of the process activities from the flowchart, the applicable department, then the description of risk as to what can go wrong, description of control, evidence, control effectiveness testing, the nature of control, whether it is key, non-key, manual, system, preventive, detective, control frequency, and the personnel responsible. and the person responsible. So this is the template of the risk and control matrix which needs to be filled up by the implementer of IFC. At process level, let's look at certain key items to be covered in the risk and control matrix. So when the auditor is testing the RCM or the auditee is preparing, they can look at the organization structure of the process. So continuing the FACP example, the auditee or the auditor can look at the CFO's office structure. So whether the CFO directly involves himself or herself in preparation of books of accounts, which is not segregation of duty. It violates the principles of segregation of duty because he's the approver of financial statements, so he cannot be the maker. So segregation of duty has to be seen. The structure of the accounting and finance function has to be evaluated. What is the delegation of authority power has to be seen. What are the maker-checker controls? What are the controls over exception reporting that the CFO's office has got? Like say, for example, if the books of accounts have closed on 10th of April, so any entries that are done in the ERP for the previous period should only be done with the authority of the CFO's office. It should not happen that after the closure and the cutoff and the lock of the accounting period is applied, still team members continue to do backdated entry. So it will become an exceptional report which needs to be monitored. Controls over management override. So if there are any key accounting balances where the CFO has got complete authority, like say for example, creation of vendor masters and making payments to vendors. If the function is not segregated and the CFO office controls creation of vendor masters and also making vendor payments, then he can very well override the entire process and make fraudulent payments to vendors for personal gain. So the auditor has to see whether management override is possible or no. Auditor has to see whether the input processing output control cycle is appropriately applied. Related party transactions are valued at arm's length pricing, and there is a approval from the audit committee on related party transactions. There is appropriate compliance related monitoring in the RCMs, period and year end provisioning and accruals, outsourcing vendor servicing agreements as well as operations, turnaround time and service delivery. This is an important efficiency objective in the RCM. If we are able to highlight what are the turnaround times, say for example, processing of vendor invoices. If MSME invoices have to be processed within 45 days, but the turnaround time is 60 days, then it violates the legal requirements of the country. So those specific turnaround times and service delivery requirements have to be mapped into the RCM. And finally, the management reporting. So these are the illustrative key controls that one needs to look at while creating the risk and control matrix. As far as information technology is concerned, the list is pretty long. We need to see the user access management, backup controls, change management, incident, virus, malware protection, endpoint security. In the given current COVID context, this is a very important slide. Internal financial controls and particularly ITGC controls within IFC will undergo tremendous change on account of COVID impact and work from home, where there will be large number of hacking attempts. You'll be reading in the press also that are happening in cyber vulnerabilities, because so many thousands and lakhs of people are now started to work from home. So obviously there are a lot of vulnerable spots available on the internet for hackers to attack. So ITGC controls are very important as far as internal financial controls are concerned, specifically in the context of COVID now, and the endpoint security and security of virtual private works, etc. And risk-based authentication is of primary importance and gaining currency in the COVID context. As far as the last section of my presentation, I have summarized for you certain globally reported deficiencies, internal control deficiencies that have been auditors. in USA, in India, as well as other regions. These are the typical internal control deficiencies that have been qualified in internal financial control over reporting. It's a brief summary which will give you an idea as to what are the vulnerable processes that you should safeguard against or you should check while you are testing the internal financial controls. The first is vendor and customer balances. So if vendor and customer balances are not confirmed, you are in a red zone. More often than not, you will be failing in your internal financial control exercise, and the auditors are going to be qualifying this particular aspect. Second is for revenue recognition. All revenue recognition needs to be supported by credible electronic or physical evidence of goods or services being passed on to the consumer or to the recipient. If there is lack of evidence of ownership or title being passed on to the consumer, to the recipient, then the auditors are going to qualify as weak internal financial controls. So we should see that the underlying business arrangements are communicated, are evidenced properly. Second is absence of documented control procedures. So where there are no standard operating procedures, no risk and control matrices, etc., no flowcharts, then auditors are going to qualify. Third is accounting for foreign currency transactions. Most of the organizations don't understand how to translate the foreign currency transactions effectively and record them in the books of accounts and translate them as per the accounting standards on 31st March and recognize the differences. So here's a vulnerable area which auditors pick up. And given the fact that the regulatory authorities, RBI may have a different way of valuing foreign currency transactions, GST authorities may have a different way. So all this creates complexity. Next is ESOP related accounting treatment. So again, there is a complexity here where accountants don't recognize when the ESOP is, what is the ESOP scheme, when it is granted, when it needs to be accounted, when tax needs to be deducted on the ESOP grant. So all these complexities make this a vulnerable account. Then recording of expenditure does not happen correctly in the accounting period. So what auditors do is that they pick up quarter one samples when they come for audit to compare it with quarter four, and then they go back to the management and say that this was all expenditure to be recorded in the previous year, but you have not recorded that. So it becomes a very simple exercise for the auditors to pick up the vulnerability. Incompetent accounting personnel. This largely happens as far as derivative transactions are concerned, which are very complex, and there are cross-currency swap derivatives where auditors have qualified for banks and for financial institutions. Management not undertaking adequate review of financials. This is a very common thing which auditors identify. The chair of the audit committee will rely on the CFO. CFO will rely on the head of accounts. Head of accounts will rely on two of his deputies. And if someone has missed out something, the second layer will not pick it up. And it just goes as a chain of trust. So, and then the auditors pick up and they start qualifying. Poor procurement and supplier management practices where KYC of vendors is not done, registration of vendors is not done. So this becomes a vulnerable area. Last 3 points are inadequate segregation of duties and poor access controls as far as information technology. Lack of three-way match for sales and purchases. Three-way match is availability of purchase order, GRN and invoice. And organizations fail to match these three documents to give evidence to the auditors, and likewise to the in case of sales and revenues also. Customer order with the dispatch order and with the logistics evidence, matching all the three. So if the three-way match fails, the auditor is going to then qualify as far as internal financial controls are concerned. And lastly, valuation for trading and settlement activities. There are various types of trading and settlement activities in capital markets, in commodity markets, which different types of settlement, T+1, T+2 cycles, and organizations operate abroad in different regions, different geographies with different trading cycles. So what they end up doing is they incorrectly value on the basis of the settlement cycles which the auditors pick up. So these are the globally reported deficiencies as far as internal financial controls are concerned. And the last slide that I will share with you on the subject is on the internal control weaknesses observed by the Association of Certified Fraud Examiners. So they also do research on an annual basis, and they come up with a lot of deficiencies which based on the fraud investigations and the reports that they research on. So they've identified three areas where internal financial controls and internal controls are primarily failing. First is lack of internal controls. So organizations fail to design adequate internal controls in terms of policies, procedures, and so forth. So that becomes a big qualification point. Second is where controls are existing, those controls are not effectively implemented, and process owners override those controls. So like say for example, where the SOP says that you have a purchase order, you release a GRN in the system, and then there should be a vendor invoice. So the procurement head still for an emergency purchase will go ahead and not have a purchase order and just have a GRN and an invoice. So here there is overriding of controls that happens in emergency situations where again controls fail. And third is lack of management review, which I highlighted earlier, where organizations trust their team members so much that they stop reviewing what the second line has done. So they don't verify the effectiveness of the evidence that is brought forth, and they simply sign it in good faith and trust. So these are the primary areas where internal controls are failing. So with that, I think I've consumed my time as well as I've completed my slides. So now I'll leave it open for any kind of a question answer. I hope my voice was audible, my speed was okay, and you all could relate to what I've said today.
Thank you very much, Huzeifa Bhai, for the wonderful presentation, and the takeaways are more and more and more. I mean, we can, any number of takeaways are there from your presentation, and